How does long-term capital loss affect tax loss harvesting? Imagine you have investments that you've held for more than a year, and some of them have lost value. You might be wondering how these losses can help you save on taxes. Well, long-term capital losses are a key part of tax loss harvesting, which is a smart way to lower your tax bill. When you sell investments at a loss that you've held longer than 1 year, these losses can be used to offset your long-term capital gains. Since long-term gains are taxed at lower rates than short-term gains, this can be a big advantage. Tax loss harvesting means selling investments that are worth less than what you paid for them to realize a loss. You then use that loss to reduce the taxes you owe on gains from other investments. If your total capital losses are more than your capital gains, you can use up to $3,000 of the excess loss to lower your ordinary income each year. Any leftover losses can be carried forward to future years to help reduce taxes later on. Because long-term capital gains are taxed at lower rates, using long-term capital losses to offset long-term gains makes your tax savings more effective. This way, you pay less tax on gains that are taxed at these favorable rates. If you have both short-term and long-term gains, the IRS requires you to match losses with gains of the same type first. So, long-term losses go against long-term gains, and short-term losses against short-term gains. After that, any remaining losses can be used to offset the other type of gains. For Asian American investors with diverse portfolios, understanding the difference between long-term and short-term losses is important. Using long-term losses can help you manage your tax bills better, especially when combined with reinvesting in similar securities to avoid wash sale rules. Remember, tax loss harvesting only applies to taxable accounts, not tax-advantaged accounts like individual retirement accounts or 401(k) plans. It's also important to avoid buying the same security within 30 days of selling it at a loss. This is called a wash sale and can disallow your loss. Consulting a tax professional familiar with your financial situation can help you make the most of your tax loss harvesting strategies. By planning carefully, you can reduce your current taxes and boost your after-tax investment returns. This approach aligns well with broader tax planning and saving strategies, helping you keep more of your hard-earned money.